Hello, everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, July 12th, 2025. How's it going? Thank you for coming to my weekend review podcast. I hope you had a good trading week. I hope you are having a nice weekend, and I hope you're going to learn a lot of good things today in today's podcast. So, the structure for today's podcast is, first of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back and we're going to take a look at all the positions and all the trades that I made last week. We're going to talk about when I entered the trade, why I entered the trade, what were the signals, what were the confluences of signals, and the overarching conditions of the market of why I took the trade. We're going to talk about how I position size correctly based upon the current volatility of that particular market. We're going to talk about where I place my emergency stops, where I'm going to place my end of bar stops, how I'm going to take partial profits if the position starts moving my way, how I'm going to go into trailing stop mode, and then how I'm ultimately going to exit the position if we get into significant overhead resistance. So we're going to talk about when I entered the trade, why I entered the trade, and then how I am going to manage the trade going forward. So we'll take a look at all the trades, winners, losers, open positions, closed positions. And so hopefully this will give you a good idea of how I look at trading and how I manage trades. After that, we're going to talk a little bit about trader psychology. Trader psychology is the most important skill that you can learn and you can develop in trading. And really all that means is what's going on in your mind in regards to your trade, and ultimately, are you following your process? It is so important, everybody. I have been trading for over 30 years. It's so important. Every day, I know this more and more, and I see this more and more, that you need to get yourself a trading process, a trading plan, and then the key part, the difficult part, is to follow it. And some people have no problem whatsoever. Some people really have a problem with this. But all in all, the trading plan is important, but it's not as important as following it. Usually when we come up with trading plans, they're, without being in the position, they're pretty good. Okay, I've got a good risk to reward ratio. If it goes up here, I'm going to hold it. If it goes down, I'm going to get out quickly. You know, there's a lot of different trading approaches, but following it is the key. And so that's why I always like to touch on trading psychology. Helps me to teach it, and I hope it helps you to hear it and to learn it. And then after that, I have gone down through my master watch list. I go down through my master watch list every Friday night, and I go through all of my symbols on the watch list, both on the daily time frame and the weekly time frame, and I identify potential setups for next week, for the upcoming week, that are getting close to some significant levels of support and confluences of conditions, both on the daily time frame and the weekly time frame. They're not there yet, but they have a chance of getting there next week. And if they get there next week, then I'll definitely consider the trade. So we'll go down through those. I've got them on the daily and the weekly. Actually, quite a lot on the weekly. Interesting. Sometimes I have a lot on the daily. Sometimes I have a lot on the weekly. But this week I have more on the weekly. So anyway, I hope you're going to learn something today. I hope you're going to find it value. And if you do, I really would appreciate it if you could hit the thumbs up button. Just takes a second and lets YouTube know that there's some valuable content here for people. People are learning some things. And if you haven't subscribed, I really appreciate it if you could subscribe as well. So let's go ahead, run the U.S. legal disclaimer, get that out of the way, and then we'll get started. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started with the current open positions. This is MasterCard MA. I entered MasterCard on the 20th of June here at $532.95. So first question is, why did I enter? So when it comes to my trading, the important thing for me to enter a position is I need a combination, or I need a confluence of signals happening. Because, somebody asked me the other day, why is that important? Well, it's important because many different traders trade different signals. And so if one signal happens, then that's like one group of buyers coming in. If another signal happens, maybe that group only trades that signal. Do you see what I'm saying? So every single signal is essentially a different group of buyers. And if you're in the company with the most amount of buyers total, the better chance that you have, right? So here's MasterCard. Let's take a look at this black line. What is the black line? Well, the black line is a 200-day moving average. It's a major level. It's a major moving average level that a lot of investors key off of. And, there's thousands, hundreds of thousands of people that key off of the 200-day moving average. This is a deep dip buy signal. And so you have the 200-day moving average, you have the 250-day moving average, the purple line, you have the 300-day moving average, the orange line. These three key moving averages are what I look for. On the dailies, weeklies, intraday, it doesn't matter. But, so you can see during the day, on the day that I entered the trade, it went below the 200-day moving average, and then it closed back above it. That is called an intraday rejection of the 200-day moving average. That is a legitimate entry signal, deep dip buy signal. But if we look down here at the RSI, on the same day that we went under the 200 and closed over the 200, we also went under the 30 RSI during the day and then closed back above the RSI at the end of the day. That by itself is also a legitimate signal. It's also a deep dip buy signal, right? In my deep dip buy course, if you take this course, you will see that a rejection of the 200-day moving average by itself is a legitimate signal. The rejection of the 30 RSI by itself is a legitimate signal. But together, they're better, right? We're better together. So on the day, we went under the 200, over the 200, closed above it. On the 30 RSI, we went under during the day, closed back above it. There's your confluence. And this is a very, very good signal. I was talking with my friend Steve Burns maybe 3 weeks, almost a month ago, and we were talking about the importance and the strength of this particular signal. Rejection of the 200, at the same time rejection of the 30 RSI, and that's exactly what happened. And it closed just barely above the 200-day moving average, which is ideal because that is now my end of our stop. And so it gave me a really good risk to reward ratio. So this is the reason for the entry. So as soon as I enter the trade, I have to decide how many shares to buy. Well, this is very important, and a lot of people do not, I think, spend enough time on this. And it's important, in my opinion, that you position size based upon the current market volatility. And so what indicator tells us what the market volatility is? It's this. It's the average true range, because it measures the movement over the last 20 days, which is another way of measuring the volatility. So what I do, I use two inputs. One, how much do I have in my trading account is the first one. The second one is, what is the value of the average true range, or in other words, twice the average true range. So right now it is 26.18. So what I do is I take 1% of my total capital. Let's say I have a $100,000 trading account. 1% of 100,000 is $1,000. And then I simply divide it by the value of the 2 ATR. Divided by 26.18. That tells me to buy 38.19 shares. So I just round that down to 39 shares. Based upon a $100,000 trading account and based upon the current marketility of this market, this is the amount of proper shares, at least the way that I trade. Now, could you do 2%? Could you do 3%? Sure, 100% you could. And I know people that do. But obviously you have more risk, right? So, and it works for any amount. If you have $1 million trading account, 1% is 10,000, right? So if you have a $50,000 trading account, 1% is 500. So it works with anything. And just doing this simple calculation will adjust properly for the volatility in respect to how much money you have in your trading account. All right. So that is how I pick the amount of shares that I buy. So I enter the trade. I entered the trade 532.95. The first thing I do, most important thing I do, is I just go right back to the value of the 2 ATR of 26.89. I take my entry price minus the value of the 2 ATR and I put a line. This is now my emergency stop. So if I have 38 shares and it moves down 26.18 down to my emergency stop, how much have I lost? I've lost $1,000. I've lost 1% of my account. Not fun, but it's not the end of the world, right? You can recover from a 1% loss. But the good news is that this only happens, hitting your emergency stop only happens about, in my experience, about 5% of the time. The other 95% of the time, if you have a loss, it will be because of your end of bar stop, which will be much closer than your emergency stop. So the very next day, had it closed, keyword closed, below the 200-day moving average, I simply would have gotten out for a loss, but not the emergency loss percentage, right? Maybe 0.1%, maybe 0.15%. So that's the key. Having your emergency stop in the worst case scenario, and you've already done the math, if that happens, 1% of your account. But again, only happens about 5% of the time. Other 95% of the time, if you have a loss, it will be because you have a close below your end of bar stop, which is going to be much closer to your entry price. All right. So as soon as I enter, I place the emergency stop. I know where my end of bar stop is. The next thing I do is I take my entry price. Then I look at the value of the 1.5 ATR. Right now it's 19.63. I take my entry price and then I add to my entry price the value of the 1.5 and I place it above. So this orange line is 1.5 ATRs above my entry. So this is now what is called my trailing stop mode level. If I get to this mode or higher, then I go into trailing stop mode. And what that means is that once it gets to my trailing stop mode, if I have a close below a previous bar's low after reaching the trailing stop level, I'm going to exit 1/2 of my position. Because if you have moved up 1.5 ATRs, you have a nice trade going. You're in the money nicely. But if it then closes below a previous bar's low, that's kind of a warning flag that you may be heading back down. So I want to take half, not all, just half. So, and one of the best things in trading for me is taking half, because if I sell half and then it continues to go down, I am glad that I sold half. If I sell half and it continues to go up, I'm glad I still have half. See what I mean? So once it gets to 1.5 ATRs, once it gets to the trailing stop mode, then if I have a close below a previous bar's low, I'm going to get out of half the position. So everything I've talked about so far, the position sizing, the emergency stop, the end of bar stop, going into trailing stop mode, these are all defensive moves. In other words, if something in the trade goes against me, I'm going to do something. But I also like to play offense in my trading. And it makes sense. You have to be balanced, right? You have to play offense and defense. And so how do I play offense? I play offense by selling a portion of my position each day if it moves up a certain amount from the previous bar's close. So here, I'll show you exactly what I mean. So what I do is I look at the closing price. Right now, the closing price is 550.18. So I take that number, and now I look over at the 0.45 value. The 0.45 value is $5.89. So I take the closing price plus whatever the value is that day of the 0.45 plus 589. My first profit target for Monday is $556.07. And if it gets there, I will sell 10% of however many shares I went into the day with. Okay? If I have 40 shares, I'll sell 4 shares at that first profit target. But I place 3 profit targets every day. So I have the first one, which I just showed you. Then the second one is very easy. I just take the first profit target, add the 0.45 to it again, plus 589. The second profit target for Monday is 561.96. And if it got there, I would take another 10%, right? If I have 40 shares, 4 shares at the first, 4 shares here at the second, and I just do it one more time. I take the second profit target plus the 0.45, and my third profit target for Monday is 567.85. If it gets there, again, I sell another 10% or another 4 shares right there. All right. And I do this every day. So if it opens and goes straight down, I'm not going to hit any profit targets. If it goes up a little bit, or if it goes up a decent amount, maybe I hit 1. If it goes up really nicely, I hit 2. If it goes up super great, I hit 3. Right? So I don't hit the profit targets every day, but I put them in and recalculate them every single day. So, okay, so that's kind of an overview of how I got everything set up, and so let's see what happened. Okay, rejection of the 200-day moving average and the 30 RSI, that was confluence. I entered at 532.95. My end of bar stop is just to close below the 200. My 2 ATR emergency stops down there. The next day goes up nicely right off of the bat. I hit 2 profit targets on this day right off the bat. Took those profit targets off, reduced my position size, locked those in. The market can't take it away from me. Next day up again really nicely. I believe I hit 3 profit targets on this day. And I also got to trailing stop mode. Doesn't mean that I do anything. It just means that now in the future, if I have a close below previous bar's low, I'm going to get out of half. That happened the very next day. Do you see how we closed below the previous bar's low after reaching trailing stop level? So, however many shares that I had left after discounting or subtracting the amount of shares that I sold in my intraday profit targets, I sold half of those. And so I did sell half of these here, and I locked in a gain of 3.07%. So next day went down, no profit targets. Next day did go up, hit a profit target. Next day did go up, hit a profit target. A couple days here moved up, but not enough for a profit target. Got another profit target here, which was nice. And then we moved sideways, didn't have any profit targets. And then Friday we had this big down bar, which, by the way, I found quite rude, MasterCard, but that's how it goes, right? So I've already done my trailing stop rule here and sold half. So now going forward, if it keeps going up, I'm going to take my partial profits each day if I have them. If it continues to move down, I will stay in the position until it closes under the 200-day moving average, because that was my initial stop. Now, if we get up to the 65 RSI level, then I have other rules that come into play. I'll get out with a close below the 5 EMA. If it rejects the 70 RSI, I will sell half the remaining shares. If after that I have a close below previous bar's low, I will get out of the rest of the shares. I know that sounds complicated. It's really not, though, once you learn it. But I know at first glance it sounds like there's a lot of rules. But I do have a lot of rules. And the reason I have a lot of rules is because I've been trading over 30 years, and every single rule I have is there for a reason. To make more money or to lose less money and and to protect myself. So, um, I do teach private one-on-one lessons. I teach people all over the world. I teach a 20-hour course now, one-on-one, and I'll talk more about it towards the end of the podcast. But if you are interested in learning all the strategies that I use, I'd love to teach you. I'd love to have you as a student, and my email and my contact information is in the bottom of this YouTube channel. So the remaining shares that I have on MasterCard doing nicely, up 3.14%, even after the big move down on Friday. So again, this was a deep dip buy, combination deep dip buy, rejection of the 30 RSI and the 200 out on the same day. Okay, let's go to McDonald's. McDonald's also a deep dip buy, by the way. Remember, deep dip buys use the 200-day moving average, the black line, the 250-day moving average, the purple line, and the orange line, which is the 300. And I picked up McDonald's here with an intraday rejection, this time not of the 200, but of the 300-day moving average. And so I entered the trade here at 285.61. I position sized correctly. I placed my emergency stop 2 ATRs below. My end of bar stop is just a close below the 300-day moving average, the orange line. You can see very close to that to begin with. So the risk to reward ratio was perfect. I placed my 1.5 ATR trailing stop level above my entry, and if it goes up at least the value of 0.45 ATRs, I will take partial profits. Next day, moves up, right? Took partial profits, took multiple partial profits. Next day, no profit targets, but I did get to trailing stop level. Now I'm in trailing stop level. Next bar, up again. Took more partial profits. Then we had a bit of a pullback for 3 days, no partial profits. And then here on the 8th of July was our first close below a previous bar's low after reaching trailing stop level. What did I do? I took off half of the position. That's what my rules tell me, for a gain of 2.14%. And then the next 3 days it rallied. Next day it rallied, not enough for a profit target. Next day here, Thursday, up nicely, hit multiple profit targets, and then again up Friday, hit a profit target. And so the remaining shares here on McDonald's doing nicely, up 4.77%. So, but you see how I keyed off of this 300-day moving average? It was a major level that was rejected. I waited for the market to show me that it was rejected. I position sized correctly. I enter the trade. I didn't know it was going to go straight up, but I did know what I was going to do. That line, my line in the sand, was this 300-day moving average. If it the next day it just closed below it, boom, I'm just out, right? My worst case scenario, I'm only going to lose 1% of my account, but that doesn't happen frequently, right? The very next day, even with 1 penny below, I would be out for a small loss. And I can always get back in if it were to close back over. But fortunately, this trade went my way, and I really did quite get the bottom. Not because, because I was lucky. No, I waited for a rejection of a major average. And I'll show you in some of the trades that I'm going to show you in the future. I had similar trades to this. They just didn't work. They did close below. I had to take a small loss, which is fine, but I can always get back in them, and I'll show you that. So McDonald's, remaining shares up 4.77%. And again, deep dip buy. Etsy. I was so happy to get this trade for multiple reasons. One, it's been a really good trade. And two, I use and I teach 7 different strategies. And with my current students, several of them have said, hey, Greg, I haven't seen you take a higher low V1 or V2 lately. Do you not use that anymore? And I said, no, I love those trades. It's just that in this particular market, we really haven't had this setup. We really haven't had these type of trades show themselves until Etsy. And Etsy is a perfect example of a higher low V2. So what is a higher low V2? Well, the first thing you need to look at is this green line and this green line. This is the 1 ATR. This is the -1 ATR. Anywhere between the low of this green line and the high of this green line is considered the value zone. So anywhere in here is considered the value zone. So the rules for a higher low V1, V2 is first, you have to close below the low of the value zone. Well, it did this here and it stayed below the value zone this entire time. The second, so the first is you have to close below the value zone. The second requirement is that you have to close in the value zone, which we did here. Then you need a pullback, and then you need a V2. The V2 consists of 3 bars, bar 1, bar 2, bar 3. 2 has to go below the low of bar 1. 3 has to close above the close of bar 1. That is a V2. There's also V1s, which consist of 2 bars. And if you'd like to learn more about V1s, V2s, you can go to my YouTube channel in the lessons playlist, and I have a video that explains them in detail. But they're really good entry signals. So again, the requirements for a higher low V1, V2 is first, you have to close below the low of the value zone. Second, you have to close in the value zone. Third, you have to have a pullback followed by a V2. Bar 1, bar 2, bar 3. Bar 2 goes below the low of bar 1's low. Bar 3 closes above bar 1's close. And that V2 has to happen in the value zone. And we call it a higher low V2 in this case because this low here is higher than the previous low. So it's a higher low V2 in the value zone. So I entered this here at $54.06. I position size like I always do. I placed my emergency stop. Oh, you know what? I did not even place my emergency stop line. 466. Okay. I knew where it was. I just didn't place the line. So I placed my emergency stop 2 ATRs below my entry for the worst case scenario, right? And if I get there, I'm going to lose 1% of my account. But on a V1 or a V2, higher low in the value zone, I'm not using a moving average, or I'm not using a 30 RSI. So where is my stop? My stop is a close below halfway of bar 2. Or in other words, halfway below the low, or halfway, a close below halfway of the washout bar. Bar 2 is the washout bar because it washed out bar 1's low. So there's 3 bars, bar 1, 2, 3. 2 goes below bar 1, or in other words, washes out bar 1. That's why I call it the washout bar. So when this trade, this V2 confirmed higher low V2 in the value zone, the end of bar stop is a close below bar 2, halfway. Why halfway? Well, halfway is significant from a Fibonacci standpoint. It should have support here at halfway. If it closes below that halfway mark, statistics have shown that more often than not, you're going to be lower, right? And so it just makes sense. So you can see I have a very good risk to reward ratio here on this V2. If the next day it had closed here, okay, I'm out. It's less than my emergency stop. It's much higher, right? But I've got the emergency stop there just in case. So then I took my entry price, added my 1.5 ATRs above it, and the next day after the higher low V2 just took off beautifully and got me into trailing stop mode. You can see, but I haven't taken any action because I need to close below previous bar's low. And then nothing really happened on Friday. So this trade doing very well. Let me get rid of this here. This trade doing very well in 2 days. up 6.57% on the higher low V2. I really love these. I take them all the time. They just haven't happened, but this is a good example of how they've happened this week. So those are the three open positions. MasterCard, remaining shares up 3.14%. McDonald's, remaining shares up 4.77%. And Etsy, remaining shares up 6.5%. Kind of the key here, everyone, is that when you have profitable trades, stay in them as long as your rules are telling you this. Now, do we have losing trades? Of course, I have losing trades all the time, but the only difference with the losing trades is when they're losing trades, I get out quickly. When they're winning trades, I stay in and follow the process, right? So I did have to lock in several losing trades this week, which is fine because they were small losses. They just didn't work. I wish every trade worked, but they don't. So let's go here to UNG. These are the closed out trades. Oh man, I'm kind of glad this is the last time I have to talk about UNG because I have been in UNG for a long time. What does that mean? It means that the trade was probably positive most of the time if I was in it that long, right? So this is what is called an order block. And an order block is this green box here. What makes this an order block? And I love trading order blocks. I use them, I teach them, I use them every single day. And I teach them every single day. But an order block is the lowest bar closed before market structure change. So what in the heck does that mean? Market structure change to the bullish side. The requirements for this are, first, you need a swing low, followed by a swing high, followed by a lower swing low. And then after that swing low, you have to take out the first swing high. And then that changes market structure, and it defines the lowest bar close before market structure change as your buyable area. Now, I don't chase the breakout, but I wait for a pullback back to the order block. And so I entered here at 1560. I entered here at 1566 on the 19th of May when we got to the top of the order block. I placed my trailing stop level 1.5 ATRs above. I placed my emergency stop 2 ATRs below, as always. The very next day, boom, right up, right? It respected that order block and moved right up. I hit multiple profit targets. Got to trailing stop level. Next bar, not much. The next bar was our first close below a previous bar's low after reaching trailing stop level. I locked in half of the shares, which you'll see is important that I did this, for a gain of 6.01%. Then we kind of moved up, not enough for profit targets. Then we moved back down. Oh, by the way, my end of bar stop is a close below the order block, right? And so I've been in this trade for months. And so then we've moved back up. Every time we moved up, I took partial profits, moved sideways, didn't do anything, moved down, no profit targets, but still staying above my end of bar stop level. Then we had a nice 5-day run up here, which again, I took partial profits into the strength. I always take something off when the market gives me something. And you can see that was important that I did that straight up and then straight down, and then another big move up here, which again, I took partial profits, and it was able to hold this order block for a long time, just barely. But then here on the 8th was the first close below the first close below the low of the order block. I had to get out of the trade, the remaining shares, for a loss of 5.87%, which seems like a lot, right? But think about all the profit targets that I took on the way, sold half, scaled in, right? So yes, the remaining shares, I did lose 5.87% shares there. But all in all, I think I made money on this trade because, again, taking the partial profits, going into trailing stop mode, taking half. Makes sense? But anyway, we're out of it. I'm glad because I've been talking about this for weeks. But the remaining shares, the small amount of remaining shares I had, I did have a loss of 5.87% on UNG. Alibaba. Well, this was rude. I'll tell you what. You know, when I tell my students, no matter how good of a setup that you have, do not expect it to be a winning trade. Now, the better setup, the more likely it is, but sometimes the best setups still do not work. And this was the case on Alibaba. Alibaba had a great setup. I entered Alibaba here on the 8th of July at 108, uh, 108, $108.07. Why? We have this order block, which is the green box here. We had a rejection of the high of the order block. The previous day we were below the order block, we closed back above it. We also had a close over the 200-day moving average, deep dip buy. We had a close under the negative third ATR channel, over the negative third ATR channel. This is a dream setup. I placed my emergency stop 2 ATRs below, and then my end of bar stop on this one, I'm keying off at the 200-day moving average. And then the next day, we had some news, gap down, boom. So I took a loss on this particular trade of, let's see here, 3.71%. No fun, right? Did I want to stay in? Yeah, I kind of did. But I got out because my rules told me. Look, if it closes back above the 200-day moving average, I can always get back in, right? Or if it continues to go lower, I can key off this 250-day moving average. But the real key here is the positions that I have that are profitable, I'm going to be in them for many days, if not weeks. But the losing positions, how fast was I out? I was out one day. And that's good trading. Letting the winners that you have, you be in multiple days, multiple weeks, maybe even a month. But having a loss and being out in one day, that is a good sign. That's a good sign of a trader that's following their rules. I know it doesn't sound like it. It's not fun. Great setup, didn't work. It's okay. That's not the important part. The important part is, as soon as the market told me I was wrong, I got out. Okay? So BABA, a loss of 3.71%. Berkshire Hathaway. This has been another challenging market for me. We are inside a bullish order block. This is the green box. Here, I took the trade on the 8th of July with a rejection of the 250-day moving average. Intraday rejection, meaning we went below the 250 during the day, we closed back above. That's a deep dip buy. Deep dip buy in any major moving average that lives inside a order block, a bullish order block, that's a confluence of signal. So I took the trade here on the 8th of July at 477.59. So I position size based upon the volatility, like I showed you. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 250-day moving average. Look what happened on Friday. Started off, went down. It's like, oh my gosh, this is like another Alibaba. But it recovered at the end of the day. A lot of it lost, but not everything. But it closed below the 250-day moving average. That was my end of bar stop. So what did I have to do? I had to get out of my position for a small loss, 0.37%, right? But listen, here's the key. Monday, if it closes back above the 200, I can get in it again. Monday, if it goes down, I'll be sure glad that I took that small loss, and I will then be trying to watch Berkshire Hathaway for rejection of the 300-day below it. Okay, so for me to get back in Berkshire, it either needs to go higher and close above the 250 or go lower and reject the 250-day or the 300-day moving average. Listen, in addition to this, we have a double bottom bullish MACD divergence. Look at these lows here, corresponding deep MACD bars here. MACD is a measure of momentum, so a lot of downwards momentum. Then we rally, bars go green. Now, Are we lower here than we are over here? We certainly are. But is the depth of the MACD bar as deep as over here? No. What that means is from a MACD perspective, the selling is drying up. And what's the implication of that? If you run out of sellers, you will go up, right? What makes the market go up? You run out of sellers. So I really still like this trade. This attempt here on the 8th didn't work, but I kept the loss very small, which is completely acceptable. And so going forward, either a close back above the 250 would get me back in, or if we go lower, a rejection of the 300 would get me back in, but a loss of 0.37%. Tesla, another small loss, kind of frustrating because I had a nice gain, but I entered here on the 1st of July at 299.51. Why? Well, green box is the bullish order block, and we rejected the 100-day moving average in this case. So I got in 299.51. I have my emergency stop 2 ATRs below. My end of bar stop is simply a close below this 100-day moving average. Next day, gaps up, goes up, great, fantastic, hit some profit targets, which is important based upon how this trade ended up. Next day, up a little, no profit targets, and then boom, on the day I exited here on the 7th, what did it do? It went down a lot, and it closed below the 100-day moving average. That 100-day moving average was my line in the sand. So what did I have to do? I had to get out. I had to get out for a pretty small loss. Oh, sorry. I messed that up. Yeah, 1.81% loss. But can you see that it was important that at least I took those profits here when I had them before it turned into this loss? So it's important, everybody. And this is a good example of why I take partial profits. So if it does reverse back on me, at least I've mitigated that loss. And so I got out for the 1.87% loss, and then it's gone straight up since there. I didn't get back in. That's how it goes. I'll have to see. Maybe if we come back to the 250-day moving average, I'll give it another shot. But let's see. But yep, this one ended up as a loss, which is frustrating because when you have a gain and then it turns into a loss and then you get out and then it goes right back up. But listen, that's trading, right? All you can do is follow your rules. So a loss of 1.87% on Tesla. And then last on Google, I did get out of Google here on the 7th. I entered Google here on June 23rd at 165.20 with a rejection at the bottom of the bullish order block. I placed my emergency stop 2 ATRs below. I placed my trailing stop level 1.5 ATRs above. Next day goes up, hit a profit target. Next day goes up, hit multiple profit targets. Next day went up, no profit targets. Next day went up, hit multiple profit targets. Next day gapped open, hit a profit target. I am in trailing stop mode, and then here on the 7th was the first close below the previous bar's low. I'm sorry, nope. Here on the 7th, I exited the trade. Why? I exited the trade fully because we got to a 65 RSI, and whenever I get to a 65 RSI, if I have a close below the 5 EMA, I am completely out of the trade. And so took all these profit targets on the way up and then exited because we closed below the 5 EMA, and I locked in the trade for a gain of 6.58%. So pretty good. So those are all the trades on the daily, and let's go the open and the close. And now let's go to the weekly trades. Now weekly trades, I start, you take weekly trades on a Friday because that is when the weekly bars closes. I have been in this trade for a long time as well. This is TLT. These are bonds. You can see the green box here is the bullish order block. I entered at 87.20 back on January 17th. I've been in this trade for a long time, and it's been a roller coaster for sure, but it still has never told me to exit the trade, either profitable or for a loss. And so I have, had winning portions of this trade. I have had losing portions of this trade. And then, of course, it pays a dividend as well, so that's nice. So I got in here at 87.20 with the rejection of the order block. The previous bar, we closed in the order block. On the bar that I entered at 87.20, we closed above the order block. I placed my emergency stop 2 ATRs below. My end of bar stops a close below the low of the order block. Trailing stop level is 1.5 ATRs above. As soon as I bought it, it started to head up. That week had a profit target. This week had a profit target. This week had a nice profit target, and I'm also in trailing stop mode. So I took profits all the way up as I'm supposed to, and then got to trailing stop level. Here on this bar, we had a huge bar up, hit profit targets, took it off, which I'm glad I did, especially considering where the price is now. I'm in trailing stop mode. And then this week, remember that week when bonds just melted down, had a close below a previous bar's low. I had to get out for a loss on half at 0.59%. Not a big loss, but still a loss. And then I have stayed in this trade this week here, took a profit target. Then we went down straight for a month, never closed below the low of the order block, kept me in the trade. And now we have been, over the last couple months, we have been grinding higher, but then this week we had a move back down. So this is a really slow moving trade. Currently, the remaining shares I have down 1.62% on TLT. And then UUP, I did take a trade on UUP. On yesterday, on Friday at 27.21. Why did I take this trade? I took this trade because this is really my favorite trade. When you have a bullish order block and then you have a major moving average inside of it. This order block comes from the past, but if you get back to the order block, that's the area where more times than not it will bounce. You can see as soon as we got here, it did bounce. We rallied, we came back down, but I took the trade here on Friday at 27.21. Why? Multiple reasons. One, we rejected the high of the order block, meaning that we closed below it and then we closed back above it. And what else did we do? We closed below the 200-week moving average and closed back above the 200-week moving average. So it's a brand new trade, just even on the trade. So of course I placed my emergency stop 2 ATRs below, and where's my end of bar stop going to be? It's going to be a close below the 200-week moving average. All right, so those are all the trades, both winners, losers, open, close, daily, weeklies, and yeah, so I hope that was helpful, everyone, just to kind of see how I use the different strategies and how I manage them. And in just a little bit, I'm going to show you the potential trades that I'm looking at for the upcoming week. But first, before we do that, let's talk a little bit about trader psychology, shall we? All right. So a little trader psychology. This is from Tony Stark. And, I really like this saying. It can apply to a lot of different things, but certainly to trading. There is a Japanese legend that says, if you get on the wrong train, get off at the nearest station. The longer it takes you to get off, the more expensive the return trip will be. Read that again. All right, let's read it again. If you get on the wrong train, get off at the nearest station. The longer it takes you to get off, the more expensive the return trip will be. And in regards to trading, what does it mean? That's pretty obvious, right? If you get on a stock and it goes the wrong direction, meaning that it's the wrong train, get off when you hit your stop. Get off at the nearest station. Because the longer it takes you to get out, the more expensive this trip is going to be. And listen, when I started trading over 30 years ago, listen, I can tell you, I didn't know what I was doing. And I lost a lot of money because I got into a couple stocks that I fell into that beginner's trap of, oh, it'll come back, it'll come back. Ha! You know, I'm laughing tears of sorrow at that. Boy, what I would have given to just have gotten out at my first stop. And listen, a lot of times, just like I showed you today, I got out of Tesla, boom, goes right back up. I got out of Alibaba, went right back up. Yeah, it sucks, right? No doubt about that. But listen, 15% of the time, that thing's going to keep going down and down and down and down, and you would give it anything to get out of that first stop. So, I was trained. Get out when you are supposed to. You can always get back in if it comes back up. So, one of the worst things that you can do is not adhere to your signal, not adhere to your stop, and then it comes back and you're like, see, I don't really need these stops. Yeah, you kind of do. Because there will be that one that will really, really negatively affect you. So my best advice, get yourself a plan, follow the plan. There's going to be these are going to happen a lot where you get out and it goes right back up. That's fine. It's just part of the business, right? But when you drive with brakes. If you didn't have brakes, it'd be an issue. And you need to, in your trading, you need to have brakes, and your brakes are your stops, right? So Japanese, pretty dang smart. Okay, let's get on now to the potential trades for next week. Now, here on the dailies, I have 3 potentials. That's all for next week. Just one of those markets where there's not a lot of setups on the dailies. But could all 3 of these symbols trigger on Monday? They could. Does it mean I would take all 3? No. I only take one stock per day, per time frame, right? Take one weekly, take one daily. And if all 3 of these trigger, I have to narrow it down to the very best one. How do I do that? I basically give each setup a quality score. If I have 3 legitimate candidates, I look at, okay, how many confluences are there? How many entry signals are there? I have to factor in the risk to reward ratios. I have to look at the higher time frames. I have to look at the relative strength of the market so I can choose the best one. So I give it a report card. Here I have 3, Alibaba, Berkshire, and Verizon. Maybe they all trigger on Monday. Alibaba has a score of 1. Berkshire Hathaway has a score of 2. Verizon has a score of 4. Which one am I going to pick? I'll pick Verizon, of course, right? And this is what I teach my students. I was talking about my one-on-one course that I teach. It's a great course. Like I said, I teach people from all over the world. I teach them all of the different strategies and setups that I use. We go over them. We do simulation trades. I teach you everything I know. I have turned out some really great traders. I really have. And if you become a student of mine, I will teach you everything I know. And, the goal here is to teach you a skill that you can make money with for the rest of your life. So if you're interested in becoming a student of mine, I'd love to have you as a student. I've been jam-packed with students next week. It's going to be, I'm going to have some days opening up because I have some students finishing, so I do have some openings. So if you'd like, send me an email. We can get the conversation started. And like I said, teach you everything that I know. The format for the course is it's 2 hours per session, and we do 10 sessions. So it's 20 hours of one-on-one training where I teach you deep dip buys, order blocks, higher low V1s, V2s, all the stuff that I use. So if you're interested, just reach out to my email and we'll start talking. So let's start here with Alibaba on the potentials. Now, as you know, I just got out of Alibaba. I had a nice setup here, had to get out. So I have 2 options at this point for Alibaba. The first option would be a close back above the 200-day moving average. That would do two things. One, it would get me above the 200-day moving average, deep dip buy, and it would also get me back above the green order block. Multiple entry signals, that's option number one for sure. Or if we continue lower, I have the 250-day moving average here that is inside this bullish order block. So if we head back down, bounce, rejection, close under, close over the 250, that would be another potential entry. Or if we go lower, there is the 300-day moving average, right? So I have three deep dip buy moving averages inside of this order block. These are all really good areas to test. Doesn't mean they're all going to work, but the confluence is great. The deep dip buy of the 200-day moving average, the black line, the deep dip buy of the 250-day moving average, the purple line, the deep dip buy of the 300-day moving average inside of this bullish order block. It's my favorite setup, everyone. Bullish order block along with the major deep dip buy level. All right. So again, it either has to go higher or lower. A close above the 200-day moving average would do it. If we go lower, a rejection of the 250. If we go lower, a rejection of the 300. At some point, very likely, one of these long-term moving averages will hold, and then maybe we'll, go up from here. I mean, Alibaba's just gone down, 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 but we are getting to some key levels. So I'm watching the close above the 200, a rejection of the 250, or a rejection of the 300-day moving average here. Berkshire Hathaway, again, a trade that I just got in and got out of. But listen, this is what happens in trading a lot. You could kind of stock a market, you stock a stock at a major level, you test it. If it fails, you get out. If it goes back over, you can get back in. I mean, I was barely stopped out of this on Friday, but so again, same thing as with Alibaba. If Berkshire closes above the 250-day moving average, I could just get back in. However, if it goes lower, again, we have the 300-day moving average below us. So that's what I'm looking for. Either a move up, close above the 250, that would get me long again, or if we go lower, rejection of the 300. It's human nature, and I see this a lot with my students and other traders that I know. If they get into a trade and then it fails, and then they get a new signal, they don't want to take the new signal because they feel like, oh, I just lost money on this. Now I want to go lose money on something else. Not the same thing, right? But that's not the right way to look at it. If you're in a key level, or you're at key levels like we are with Berkshire, if the first one doesn't work, don't be shy to take it again if you have a legitimate entry signal again, because these are key levels. They really are key levels. So again, if we have a rejection, if we have a close back over the 250, I will consider getting long there. If we go lower and reject the 300 inside this bullish order block, I could also take another shot at it there. And then Verizon. All right, Verizon's getting pretty close here. And if we go back in time, you can see we have a green box here. What's the green box? Well, the green box is a bullish order block. So we have created a bullish order block. And again, why did we create a bullish order block? Well, we had a swing low. We had a swing high. We had a lower swing low. We changed market structure to the upside. The lowest bar close prior to the changing the market structure to the upside defines our order block, the high and the low of this bar. We take the high and the low of that bar, we put it out into the future. And look, I didn't take this trade. I didn't even see this trade. This would have been a perfect trade. You see the bounce at the 200-day moving average that's inside the bullish order block, and then just took off from there. I didn't take the trade. It would have been great. But now we're getting back to the same area. We have the 200-day moving average that lives inside of this bullish order block. So for next week, what I'm looking for is a rejection of this 200-day moving average. Deep dip buy, right? Bounce, intraday rejection, close under, close over. Just by itself is legitimate, but in addition, with the confluence of having the bullish order block as well as the major deep dip by major moving average, even better, right? So that's what I'm looking for, is a rejection of the black line, the 200-day moving average inside the order block, and right now that's at 41.04. And by the way, I've been talking a lot about deep dip buys. Of course, I teach these in my one-on-one course, but I also have a really good online video course where I teach you deep dip buys at udemy.com. The link's in the description of this video. I have sold so many of those all around the world. It's 9.5 hours of video of me teaching you exactly how to trade the deep dip buys. So that's a great course. I think it has 4.85 stars on that. And so if you want to learn one strategy, initially it's a great place to start, and it's very affordable. It's between $30 and $50 for 9.5 hours of instruction. So it's really, really good. So Verizon here, looking for the deep dip buy of the 200-day moving average inside this bullish order block, which sweetens the deal. So that's all I have on the dailies. I have Alibaba looking for a close back over the 200-day moving average, or if we go lower, rejection of the 250. Berkshire Hathaway looking for a close back over the 250, or if we go lower, a rejection of 300. And then, of course, Verizon looking for a bounce, intraday rejection, or close under, close over the 200-day moving average again in the bullish order block. Okay, let's go to the weeklies. I've got more on the weeklies here than I do on the dailies. All right. Adobe. I have been talking about Adobe for some time now. It just has not gotten there. And that's the key. Identify your levels, but wait until they come back to where you want them. Okay, I am looking at this bullish order block. Again, we're on the weeklies on Adobe. So this is a bullish order block. Why? Well, because we have a swing low, we have a swing high, we have a lower swing low. We change market structure to the upside, and once you change market structure to the upside, I look to buy dips, right? That's the key. Buy dips in an uptrend. Well, changing market structure, the way that I look at this, puts you into an uptrend. So I want to buy the dip after the uptrend occurs. Here's the uptrend, looking to buy the dip. What I'm looking for here are two things. I don't really want to buy a rejection of the high of this order block. I'm looking for a rejection of 353 inside the order block. Why 353? Because here, 425, this week, we had a big up bar. If we come back to halfway of this big up bar, there should be some inherent support there. So I'm looking for a rejection of 353 by the end of the week next week. Or, of course, if we reject the bottom of the low of the order block here at 341.31. So rejection of 353 or a low of the order block 341.31. Amazon. Okay, this is a bearish order block because it is a red bar. This is a shortable area. Why is this a bearish order block? Well, this is the opposite of the bullish. We have a swing high, we have a swing low, we have a higher swing high, we have market structure change to the downside. So if you want to buy dips in an uptrend, you want to do the opposite. You want to short rallies in a downtrend. Well, this changed us into a downtrend. So therefore, if we come back up into the bearish order block, that is the shortable area. Now, technically, this was a legitimate short on Friday for Amazon. Why? Because we rejected the bottom of the bearish order block. I didn't take the trade because there's quite a lot of range up to the high of the order block, which would be the stop. I am looking for Amazon to reject 233.70. Why this number? Because here, if we go to the left, it's the opposite. You have a big down bar. If you have a big down bar and you rally back to halfway of that, that is resistance. So again, this was a legitimate order on Friday. I didn't take it. I'm looking for a rejection of 233.70 by the end of the week. And if we reject that, and it's a good risk to reward ratio, I will consider getting short there. FedEx. All right. Here, we are in a bullish order block on the weekly. So what do I like to look for in bullish order blocks? I like to look for major moving averages inside the bullish order block. Well, here's your swing low, here's your swing high, here's your lower swing low, here's your market structure change, which defines this big bar as an order block. This order block's way too wide to do anything but look for a major moving average inside of the order block. Here, the 200-day moving average at 200-week moving average at 228.86 would be a level. I don't know if we get there. If we get there, I'll consider it. If we don't get there, I won't. But I'm looking for a rejection of the 200-week moving average at 228.86, or if we go lower, a rejection of the 300-week moving average at 218.88. So that's what I'm looking for on FedEx. Home Depot, nice order block here. Here's the order block. Swing low, swing high, lower swing low, market structure change. Market structure changes to the upside. I want to buy dips after the market structure changes. This is a very wide order block. So there's three levels that I could use here. We have the 100-week moving average that's inside the order block. If we rejected that, I could key off of that 100-week moving average, enter and use that as my line in the sand. Secondly, I could use the level of 338. Why 338? Because over here on the 11th, we have a big up bar. And if we come back to halfway of that, there should be some inherent support there. Or if we go much lower, of course, there is the 200-week moving average inside of the bullish order block. So three levels. I could key off of the 100 at 352.70. I could key off halfway of the big up bar of 411 at 338, or I could key off of the 200-week moving average at 324.40. All legitimate levels, all legitimate lines of sand to base a potential entry from, because inside this order block. United Airlines. Okay. We formed a nice little market structure change to the upside this week on United Airlines. Why? Because swing low, swing high, lower swing low, market structure change. We look for the lowest bar close prior to the market structure change. Here we are. This is the order block going forward. Well, are there any major moving averages inside that order block? No. All the major moving averages, the 200, the 250, the 300 are down here. But there is the 50-week moving average. I would consider taking a rejection. If it comes down and rejects the 50-week moving average, I would consider taking that and using that 50 as my line in the sand. Or, of course, if we reject the bottom of the order block here at 73.05, that would also be potential entry as well. And then last but not least, XLV. I've been talking about this for weeks and weeks and weeks. It just hasn't gotten there. Here is your bullish order block on the weekly, all the way down here. You can see when we did come down, down, where did we finally bounce? At the order block. Then we rallied. XLV down a little this week. But what I'm looking for, I just want the best trade I can get, right? I don't want to try to have to make a trade out of nothing. I want the simplest trade I can get in the best setup. And for me, that would be a rejection of the 300-week moving average inside of the bullish order block. And the 300-day moving average is 127.37. I don't know if it's ever going to get there, but if it does, I'll consider the trade. But wait until the market comes to where you want it to. Don't chase it. Let the ball come to you, right? Only swing at the best pitch. Well, the best pitch for me is if we get to that 300-week moving average. So that's what I got for you this week for the setups on the dailies and the weeklies. I hope you found that helpful. If you did, I'd appreciate if you give a thumbs up. I hope you have a really good rest of your weekend. Please try to go out and do something nice for somebody today. If we all did one nice thing for another human each day, it would really make the world a better place. If you could go out and do one nice thing for an animal each day, that would make the world a better place as well. If I can help you at all with your trading, really love to do that for you. Really love to have you in my course. I'll teach you everything I know. If you have any comments or questions, you can put them in the comment section. But yeah, if I can help you, please reach out to me. My email is in the link of this description. So thanks a lot for investing the time here. Again, I hope you found something helpful for your trading, and God willing, I will see you next week. But be good to yourself, follow your rules, please, and be careful next week. All right? Thanks a lot, everyone. Take care.
U.S. government stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.